Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets hidden in plain sight in the world of corporate finance, or as Rosa Holdings Corp might say, where we decide if we're buying or selling a bouquet of our own stock. Get ready folks, because today we're diving into Rosa Holdings Corp's latest filing, and it's a bit like a company trying to raise some serious cash without immediately flooding the market with its shares. We're talking about a document that outlines a plan to sell up to a whopping $150 million worth of the company's stock. This deal, which kicked off on August 4, 2025, is essentially a flexible agreement with an investor. Rosa Holdings can decide to sell shares, and the investor has to buy them, up to that $150 million cap. Now, the price for these shares isn't fixed, it's tied to what the market calls the market price at the time of the sale. This means Rosa Holdings can take advantage of good market conditions to sell at a higher price. The agreement itself, called an Equity Purchase Facility Agreement, or FFA, is set to last for about 3 years. But here's the kicker. Rosa Holdings needs its shareholders to say yes to this plan. They have to hold a special meeting within 60 days of this agreement date and get a stockholder approval for the issuance of these shares. They're also required to make sure their board of directors recommends a yes vote from the shareholders. Think about it this way. The company wants the flexibility to sell a ton of stock if needed, but they need the owners, the shareholders, to give them the green light. This is super important for compliance with stock market rules, especially on exchanges like the Nasdaq. The filing mentions that getting shareholder approval might even be handled through written consent instead of a full meeting if enough shareholders agree, which could speed things up and be more cost effective. This filing also talks about another agreement, the Registration Rights Agreement. This one is tied to the first. It basically ensures that the shares Rosa Holdings might sell under the EPFA can be easily resold by the investors who buy them. The company has to file a registration statement with the SEC, which is like an official paperwork to let people know these shares are available for trading, and they have to get it approved pretty quickly. Now, you might be wondering why they're doing this. Companies often set up these kinds of agreements, often called equity lines of credit, to have access to capital without having to issue a lot of stock all at once. It's a way to manage funding needs over time, especially if they have ongoing projects or expect future expenses. This kind of facility offers flexibility and can be a lifesaver when a company needs cash. An interesting detail here is that Rosa Holdings identifies itself as an emerging growth company. This means they can take advantage of certain regulatory flexibilities and extended transition periods for new accounting standards. It signals that they're still in the growth phase, which often comes with a need for external financing like the one detailed here. So what's the big picture? Rosa Holdings is securing a potential financial lifeline of up to $150 million. They've laid out the groundwork with an investor and are now seeking the crucial nod from their shareholders. This is a pretty standard move for companies that want to keep their financing options open, especially in the dynamic world of biotech or growth companies that might have significant research and development costs or expansion plans. The offering itself is being made under an exemption that means they don't have to register every single share with the SEC immediately, which is a common practice for these types of private placements or facilities. This exemption is based on Section 4A2 of the Securities Act, which is generally for transactions not involving a public offering. Overall analysis, quicker looking at this filing, Rosa Holdings Corp is clearly focused on securing future funding. The $150 million equity purchase facility gives them a significant financial tool. The key here is shareholder approval. If they get that green light, they have the ability to raise substantial capital over time as needed, allowing them to fund growth, R&D, or other corporate initiatives without being locked into a single massive stock issuance. A major strength is the flexibility it offers. They can tap into this facility when market conditions are favorable for selling their common shares. However, a significant risk is their reliance on shareholder approval. If shareholders don't approve the plan, this entire financing avenue is shut down. Also, the continuous reliance on external funding, especially through selling stock, can dilute existing shareholders' ownership. In conclusion, Rosa Holdings is taking a proactive approach to managing its finances by lining up this significant funding source. The success of this plan hinges on shareholder backing and their ability to execute the subsequent steps according to the agreements and regulatory requirements. It's a strategic move, but one that requires buy-in from the company's owners. Alright, that's our breakdown of Rosa Holdings' latest financial maneuver. What's your take on these plans and what they signal for the company's future? Are you a shareholder? How do you feel about this potential dilution? Drop your thoughts in the comments below. If this deep dive into corporate filings was valuable, please hit that like button. It really helps us out. And subscribe for more decoding of the corporate world. And don't forget to join our Discord community. The link is right there in the description. Thanks for watching, and we'll see you in the next decode.